In this episode, I'm going to show you how extraordinary returns are possible with dividend stocks. I'll show you an example with Coca-Cola, where you could start off with $4,600 investment in Coca-Cola and eventually end up with over $200,000 a year in annual dividends. Hi, my name is Kanwal Sarai, and welcome to the Dividend Investing Podcast. In this podcast, I'm also going to show you a couple of more examples, one with Home Depot and with Walmart. So let's get started and see how you can get extraordinary returns with dividend stocks. Follow along with Jack and Jill as they navigate through their journey of investing in dividend stocks. Before we begin, there's two definitions we need to cover first: dividends and stock splits. Let's start with dividends first. Coca-Cola has a little over 4.3 billion shares outstanding today. If you were to buy all of the shares, you would own the entire company. However, if you only bought 5 shares or 10 shares or even 100 shares, just like Jill, you would still be considered part owner of the company. And as part owner of the company, you're entitled to share in the profits of the company. And those profits come to you in the form of dividends. Remember, you are getting paid just to hold on to those shares. So let's see what that looks like. Let's say, as an example, a company is paying a dividend of $1 per share, and Jill, in this example, owns 1,000 shares. She will receive $1,000 every year for as long as she owns those shares and as long as the company continues to pay the dividend. Now, she can spend the dividends if she wishes or reinvest them. It's entirely up to her. Now, let's take a look at stock splits. A stock split allows the company to increase the number of shares to boost its stock liquidity. So what that means is they can take the share price, if it's gone too high, let's say it's $100 a share. If you can do a stock split, 2-for-1 split, you can bring the share price down to $50. Now, let's see what that looks like in an example. So let's take a look at Jill's investment in company ABC. So let's say Jill owns 100 shares in this company and the stock price is $50. So you can see that her investment today is worth $5,000. We've taken the $50 share price and multiplied it by the number of shares that she owns, which is 100. So her portfolio, her investment in this company today is worth $5,000. Now, let's say the company announces a 2-for-1 stock split. So what does that mean? It means that for every single share that Jill owns, after the split, she will own 2 shares. So now after the split, she owns 200 shares in company ABC. Now, remember I mentioned this before, the price is going to also come down. It gets cut in half. So the stock price is now $25 a share. Now, has that changed the value of her investment? No, it hasn't. You can see that now we take 200 shares multiplied by the new price of $25, and we still end up with $5,000. So for Jill, nothing really has changed. Before the split, her investment was worth $5,000, and after the split, her investment is still worth $5,000. Now, she does have double the number of shares. So she had 100 shares before. After the split, she now has 200 shares. But the important thing to remember here is that the stock split does not fundamentally change the company's value. There's more shares, but then the price comes down as well. Now, there's different types of stock splits are possible. You can see them up on the screen here. A company can do a 2-for-1 split, like we just saw in the example. They can do a 3-for-1 split. They can do a 3-for-2 split. Or in some rare cases, companies may do a reverse stock split, a 1-for-2 split. But in any of these splits, what happens is fundamentally it does not change the company's value. So then how does a stock split benefit you? How does it benefit Jack and Jill in their investments? So let's take a look here at Coca-Cola. So you can see since 2011 till up to today, you can see where the stock price is at. In 2012, the company had a 2-for-1 stock split. So do you notice anything in the stock price since the split? You can see that the price has gradually come up. Now, to get more specific, in 2010, Coca-Cola stock, this is the pre-split price, was $50.12 a share. Today, the stock is trading at $61.40 a share. Now, I've been a dividend investor for over 22 years. I've had a couple of stock splits here and there. And what I can tell you is the stock split happens, sure, the price is going to get cut in half if it's a 2-for-1 split. But then over time, over many years, we see that the price just comes right back up to where it was before the split. So as a long-term investor, this is great. The price is back up to where it was, but I now have, in the case of a 2-for-1 split, I have double the number of shares. So for Jill, if she's interested in Coca-Cola, the other thing that's going to be interesting to her is the fact that Coca-Cola has been paying a dividend since 1893. Now, that's not a mistake. I'm going to say that again. For those of you watching it, you can see it on the screen. Dividends paid since 1893. So Coca-Cola has been paying dividends for a very long time. Now, even more impressive to me is the second line right here, which is the consecutive years of dividend increases. So for Coca-Cola, it's been 59 years of consecutively increasing its dividend year after year after year. Think about how many recessions we've had in the last 59 years, how many market downturns we've had in the last 59 years. Yet Coca-Cola has managed to increase its dividend year after year, consecutively for 59 years. Now, this is extremely powerful, especially for us as dividend investors. Dividend increases are incredible because they put more money into your pocket. Every time the company increases the dividend, you are going to get more money from that investment. Now, let's put all of these two things together. We've talked about the importance of dividend increases. You understand what a stock split is. So watch what happens over the long term. Again, we are long-term investors. We are thinking 10, 15, 20 years down the road. We think in terms of decades, right? We're not looking in terms of days or months or years. We're thinking in terms of decades. So watch what happens over a number of decades when you combine dividend increases with stock splits. So I'm going to give you 3 examples today. We're going to look at Coca-Cola, we're going to look at Home Depot, and then we're going to look at Walmart. So Coca-Cola, I'm going to show you how a simple investment of $4,600 turned into over $200,000 of dividends each year, just from that one investment. And that investment in terms of just the share price, okay, I'm going to come to that in a second. I just want to reiterate the 59 years of consecutive dividend increases, which is very important. But that investment today, that $4,600 investment today would be worth over $7 million. Now, if that doesn't include all the dividends you've received over the years, that's just the increase in the share price, in the value of this investment. So for those of you, I know a lot of people are wondering, what are the numbers? Where am I coming up with these numbers? I'm going to show you those right now. So in 1960, Coca-Cola was trading at $46 a share. Since then, they've had 9 stock splits. Now, those of you watching this, you can see all of the numbers on the screen. For those of you listening to the audio version, I'm going to help you out here. So in the beginning of 1960, assuming you made this investment at $46 a piece, you would own, let's say you bought 100 shares, you would have 100 shares. In January of 22 of that year, the company did a 3-for-1 stock split. So now you own 300 shares. But nothing else has changed. You didn't sell any shares, you didn't buy any more shares. You just now have 300 shares. In 1965, 68, 77, the company did a 2-for-1 stock split in each of those years. So now you're at 2,400 shares. Again, you didn't buy any more shares or sell them. You just have 2,400 shares at the end of 1977. In 1986, the company did a 3-for-1 split. So again, now we triple that. So you have 7,200 shares. In 1990, 92, 96, and 2012, the company again did 2-for-1 stock splits in each of those years. So today, you would own 115,200 shares in Coca-Cola. So now let's take a look at the dividend today as of this recording. The dividend for Coca-Cola is $1.76 per share, and the share price is $61.40. So let's just do some simple math here. We take the number of shares that you own. So now because of those stock splits, you own 115,200 shares. Multiply that by the $1.76 dividend. You would receive this year $202,752 in dividends. And like I said before, dividends are deposited directly into your trading account as cash. You can spend the money if you wish or reinvest it. And given Coca-Cola's history, we would expect that next year you would make more than $202,000 in dividends because the company has a history of increasing its dividends. Now, if we just take a look at the number of shares you have, which I already said is 115,200 shares, multiply that by today's share price, and you can see that this investment based on share price alone is worth over $7 million. Okay, so now let's look at another example here, this time with Home Depot. I'm going to show you here how you could have taken a $2,100 investment in Home Depot and turned it into over $259,000 in dividends each year. Home Depot has had 12 consecutive years of dividend increases, so that's certainly helped to increase the dividend income. And the shares alone, again, we're taking dividends out of the equation. Those shares today would be worth over $10.8 million. Now, let's take a look at the numbers. In 1981, the share price for Home Depot was $21 a share. Since 1981, the company has had 13 stock splits. Again, for those of you watching, you can see all the numbers on the screen in front of you. For those of you on the audio version, I'll just give you a quick summary here. So you start off with 100 shares in 1981. In 82, the company did a 3-for-1 stock split. So now you end up with 150 shares. In 1982, there was a 5-for-4 stock split. And then in 82 again, there was a 2-for-1 split. In 83, there was another 2-for-1 split. And then we see a number of stock splits from 87 to 92. There was 3-for-2 stock splits. And we continue on. The most recent split was 3-for-2 in 1999. So the 100 shares that you originally owned in 1981, you would now be left with a little over 34,000 shares in Home Depot. So now today's dividend, as of this recording, is $7.60. So let's take those 34,000 shares, multiply that by the dividend today. You can see that you would be earning over $259,000 in dividends each year from Home Depot. And if we just take a look at the share price, again, we're not including dividends in here, the 34,000 shares that you own multiplied by today's share price would leave you with over $10.8 million in Home Depot shares. Now let's take a look at our last example with Walmart. In this example, I'm going to show you how a $1,650 investment in Walmart would have turned into over $458,000 in dividends each year. And based on the stock price alone, the shares would be worth today over $29.2 million. Now, Walmart has also had a number of increases over the years, consecutive increases with its dividends. Now, let's take a look at the numbers. In 1970, the shares were trading at $16.50. And since 1970, there's been 11 stock splits. So you start off with 100 shares. And then in 1971, there was a 2-for-1 split. You end up with 200 shares. And then there was another split in 72, in 1975, 1980, 82, 83, 85, 87, 1990, 1993. And the most recent split was in 1999. So those were all 2-for-1 splits. There's been 11 of them. So the 100 shares that you had in 1970, today you would have over 204,000 shares in Walmart. So if we take a look at the dividend today, as of this recording for Walmart is $2.24, and the share price is $143. So let's take the 204,000 shares that you have, multiply it by the dividend, and you can see that you would receive this year alone over $458,000 in dividends. Then we want to take a look at what the shares are worth today. Again, we're not including dividends in here. We're taking the number of shares that you own multiplied by the stock price, which is $143. And you could see that those shares in Walmart today would be worth over $29.2 million. Okay, so now we've looked at 3 examples. Quick summary, you can see Coca-Cola, $4,600 investment, would provide you today with over $200,000 in dividends. Home Depot, a $2,100 investment there, would today provide you with over $259,000 in dividends each year. And finally, Walmart, a $1,650 investment over the years, today would provide you with over $458,000 in dividends. So if we were to combine all of this, the 3 stocks together into one portfolio, your total investment in Coca-Cola, Home Depot, and Walmart, in this example, total investment would have been $8,350. Combined, those 3 companies today would be providing you with over $921,000 in dividends every single year, as long as you kept those shares and as long as the companies continue to pay the dividend. And in the case of these companies here, they have a history of increasing dividends. So next year, we would expect in this example portfolio that you would earn over $921,000 in dividends. And just looking at the share price alone, the shares in these 3 companies today would be worth over $47.2 million. So are extraordinary returns possible with dividend stocks? Yes, but it takes time. And that's what Jack and Jill are learning as well, that it takes time. It takes dividend increases, and stock splits certainly help. And just holding on to those stocks as the dividends grow. And if there's going to be stock splits down the line, that's going to be good for you as a dividend investor as well. And so that is going to give you extraordinary returns over time. Now remember, we're dividend investors. We think in terms of decades. So we have a long-term perspective when it comes to investing. So does this mean that you should go out and buy any stock today that pays dividends? And the answer to that is no. Our approach is to invest not just in any dividend stock, but in quality dividend stocks. And there's a difference. You could have 2 stocks, each paying dividends, but one of them is a quality stock and the other one's not. So you want to make sure you're investing in quality stocks and when they're priced low, when they're undervalued. If you're interested in learning about how to figure out when a stock is priced low, I suggest you go back, take a look at episode 1. I explain exactly how to figure out very quickly when a stock is undervalued and when a stock is overvalued. So how do you know when you're looking at a stock, if it's a quality stock and if it's undervalued today? So to help you with that, I've created what I call the 12 rules of simply investing. If you're watching this, you can see the rules on the screen. For those of you listening to this, I'm just going to quickly go through the 12 rules. Rule number 1, do you understand how the company is making money? Rule number 2, 20 years from now, will people still need its products? Now, I want to mention here, these 12 rules, this is a checklist. So before you invest in any company, make sure it passes all of these 12 rules. If there's even one failure, skip it. Move on to another stock. Okay, so I'm going to continue with the list here. Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8 is its debt less than 70%. Rule number 9, we want to avoid any companies with a recent dividend cut. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? Is it undervalued? And rule number 12, keep your emotions out of investing. So if anybody who's interested, I have the Simply Investing course. We go through all of the rules in detail. It's an online course, takes about 2.5, 3 hours to go through all of it. Give you some real life examples. Also provide you with a spreadsheet that you can use, free to use. You can enter all the numbers in, and it takes you step by step through the 12 rules. So you can find quality companies when they're undervalued. The other thing I want to mention, the Simply Investing platform does the work for you. It applies the rules to over 8,000 stocks in the US and Canada every single day. And then when you log in, it's an online web app. You log in, it'll show you which companies pass the 12 rules, which ones don't, where are the failures, and which of those stocks are undervalued. So we're showing you quality companies that are undervalued. We also show you ones that are overvalued, so those are the ones you would avoid for now. So the platform makes it a lot easier to filter out through all the noise and get to the quality stocks that are out there. I want to thank you all for tuning in to today's episode. If you like this episode, make sure you hit the subscribe button. Click on the like button as well. Give us a good 5-star rating. That really helps to get the word out and get more listeners to come in and understand our dividend approach. For more information, check out our website, simplyinvesting.com. And there's a new episode out every week, so stay tuned for next week. Thank you for watching.